Okay, so today is the 7 p.m. April 8th class as we get started. So the first question was about the BMC certification. So again, our deal with Bloomberg, which has changed slightly, is that we are their #1 license in the world. Like we have 60 terminals. No other school in the world actually has 60 terminals. So they've been generous to us with a couple of things. So one of the things is they've allowed us to have free web-based BMC certification, because otherwise it charges people $149. And basically, if you use a umd.edu email, you can become Bloomberg certified over the web without actually getting to a terminal if you're just interested in kind of getting an overview of the product, right? So it was our understanding, because my undergrads did this earlier this semester, that you could basically sign up on the web as long as you had the UMD email. It didn't require a code. Now, I created, and I have the ability to create BMC class codes. So I created one. It's for the undergrads. I think it shouldn't have expired because I did this in January 2020. If somebody wants to try that and it's not letting you go by the code, put the code in. The code doesn't really do anything except I, as a faculty member, have an administrative login that shows me all of my students that have taken certification using that code. That's the only reason for the code. So it just ties me to you, so I can see whether you have done it. Otherwise, it's not a requirement for accessing the BMC certification. And so just to be really clear, there's two things that are going on. You don't need to be BMC certified to use the Bloomberg terminal. Okay, so given the instructions that I put up there, you guys have seen that I've been using Bloomberg. So Bloomberg changed our license. And so there's a guy named Chuck LaHaye who manages it in IT. So a big thank you to him. He convinced Bloomberg to put us in what's called disaster recovery mode for the school. So what they did is overnight, because they turned all of the licenses online. So basically anybody at the school, or actually technically anybody that knows the address on that PDF, can basically go in and use one of our university licenses. We have technically, I think it's like 58 or 59 unused licenses. I'm going to say 50, but we can have about 50 different users logging into Bloomberg simultaneously. This applies to the whole school, but basically it's just an open license. And so as long as we don't have more than 50 people, they'll just let anybody using that login get on and use the full Bloomberg terminal remotely for the foreseeable future. And what they also said is that if student number 51, whatever our total license is available, tries to log in, it will kick off one of the students that was already in. So you can actually go in, it'll let you in, but you may not be able to stay in if a bunch of people are trying to log in and use the terminal. So I'll just let you know that you have the PhD students, you have faculty, and you got 160 undergrads that are taking my class that are all trying to use the Bloomberg terminals. So, but if anybody wants to try and actually get in there and play one with yourself, you guys have access. And that's never happened before because Bloomberg makes you actually use these terminals on campus. So if nothing else, we got lucky that they're willing to open it up because of the special circumstance we're in. I don't know how long it's going to be open, but even if you want to just go poke around, you can poke around. Now, again, they have something called BMC certification. In the BMC certification, it will kind of give you an overview of how to use the terminals if you want to play around with that. You don't have to be BMC certified. It stands for Bloomberg Market Concepts. But my undergrads, for example, they have to be certified because it actually goes on their resume. And that's important to them when they're applying for jobs. If you want to work in the financial services industry, you're going to end up being BMC certified. So you're welcome to take advantage of that, but that's separate from the terminal. And by the way, you can get certified either through the terminal by typing BMC, or you can do it through the web link, which Bloomberg normally sells for $149. And if you have a UMDE email, they're giving it to us for free. And you can actually do the web link certification without ever going to a terminal if you just want like an overview of what it does. Okay, so probably more than you needed, but just wanted to let your teams know, because if anybody of your team wants to go and trying to get additional information about the company for your group project or anything else, it's a nice value that you can take advantage of as part of your online MBA.
So that code you posted did give us access to like the BMC thing, but the the terminal access is still like the message I have here. It's, it says your terminal access has been submitted on date, time. Our representatives will review your eligibility and will call you with the phone number provided. So, I mean, I
Okay.
think there's no lag there.
So again, probably what's happening, because I asked Chuck if you could create logins outside of the lab. There's probably some minor verification they're going to do, only because if you actually create a login on campus, they just assume you're a student. They don't have any login checks. But obviously, if they're opening it up to the rest of the world, then they probably want to have at least some affiliation with the university check. But my sense is if you use a UMD email, they're probably going to say, okay, that shouldn't be a problem. And if you're in a rush, call that number. They're open 24/7. Okay? Just tell them I'm a student trying to get access. Please, verify my login. Their tech support's pretty good, because when you pay $25,000 a year for software, you expect good tech support. Okay, that was the Bloomberg rabbit hole. One other student asked while other people were joining about data. So I want to mention a couple things about your big group project. First, in the files section, one of the teams switched to, where's the teams? Oh, sorry, I'm in the wrong, switched to Costco. So I wanted just to let you know that the Costco, where are we, spring 2020, that the Costco data is there under files. So under team files, I eliminated Peloton for team projects, created a Costco folder, and I put the Costco data there on Monday. Okay. Now, for the rest of you, you were missing some of this data. I'll get it up there tomorrow morning. So you'll be able to do the valuation model stuff with your projects, and you'll have the similar screenshots there as well. So look for that very soon for the rest of your companies. The other changes I made, just so you know, is also in the files section. I created a sample presentations folder. Okay. Now, these were from my undergraduate class, but they are doing a full semester version of what you're doing. And so they had to also do final presentations. So this is from 2 semesters ago, the presentations on Microsoft, BMW, and Under Armour. And so if you want to see what a PowerPoint looks like for the final presentation, all of these students got A's on their presentations. Okay. So if you're thinking about, what do I need to put together for the final week of class? So just very quickly, this was the Microsoft team. It's probably the best of the 3 that I put up there. They basically did the same 4 sections that you're doing, which is EIC, historical, multiples, and the valuation. And what's going to be key about the presentation is, again, you guys each have 20 minutes, and you have to cover all 4 sections. So about 5 minutes per topic of the valuation. And you get a sense of, what they kind of put on there for their buy, sell, hold opinion, what they covered in their EIC, what they covered in, it's all EIC, historical, that they had to do the walkthroughs, multiples, which is next week's topic, and then the valuation, which we've been working on the last 2 weeks. Okay. This is something that you won't do. I don't think we're going to get to the sanity check. We'll see how things go. But basically, these are the things that are going to be necessary to do the presentation. The requirements are there, but I just thought to see a couple of samples might help you as you guys work together as teams. So those are in the sample presentation folders. Okay. Final thing I did that is a change is under the assignments for this coming week, there's a midterm exam. And originally there were going to be 2 midterm exams. And I decided, just given everything that's going on, to make it 1 midterm exam. So instead of a midterm 1 and a midterm part 2, you just take 1 midterm 1 all together. All right. And instead of having 2 5-point exams, it's just 1 10-point exam. Right. And the midterm exam is very straightforward. I'm giving you up to 4 hours to take the exam. But the key is you can start taking the exam. You can see this starting tomorrow. and you need to finish by April 14th, which is next Tuesday, by the end of the day. Okay. So somewhere between tomorrow and next Tuesday, take the exam. Don't click on the exam until you're ready to start, because it's going to start a timer. And you have up to 4 hours to complete the exam from the time you click on the link. And the entire exam is a repeat of the economic conversion that you've already done. Okay. So basically, you'll be given a new file. You'll have to do the conversion. You'll have to upload the conversion. And basically, that's it. There's no write-up. It's just putting in the 4 tabs in the Excel file and turning it in. And you have up to 4 hours to do that. And that's 10 points. Okay. So that's one change I want to make everybody aware of. Because before, it was this exam plus 5 essay questions. Now I've just done simple, pure conversion. That's the entire midterm. Questions about that?
With the sorry, with the conversion, is it going to be exactly like the homework? Like it's already going to be labeled with the 1s, 2s, 3s, and 4s, or are we going to have to go in and do that?
I'll actually show you a preview. Well, actually, I'm not going to show you the preview because it's recorded. Technically, somebody could go back and see it. But the short answer is when you get to this, you'll download the file. The files will have the 1, 2, 3, 4s. It'll look a lot like the homework assignment. And remember that in the assignments folder for files for whatever that assignment was, I had posted the solution. It was in week 3. So the conversion that you did is here, the solution. So you're welcome to use that. Because remember, the exam in this class is open book, open notes. Obviously, you'll need to use a computer. The only thing is you can't work collaboratively. You can't go searching for past exams. And you can't go use one of those like course sites that says, here's a history of Mr. Perfetti's past classes, and here's all the things he's ever done. So you can't use that. But other than that, it's open book, open notes. Can't use a solver. All right. So somebody else had a question, or does that answer everything?
I had a question. So if you don't get one of the statements to balance, do you get a 0, or is there any partial credit?
So each tab on the exam will be worth 2.5 points. And so to get the 2.5 points for the tab must balance. So that part will always be true in this class. You have to have a balancing tab. So, because even if you get, like I said, think of it this way. If you're in the real world and you show me your work and you say, well, it's one of these 2 numbers. I don't know which one it is, but it's one of these 2. Like, that's not going to go over very well. So that's why it's got to balance. Because if it doesn't balance, then it's just 50-50 that one of the 2 is right. And so you can't tell me which one of the 2 definitively is right, so I can't give you credit. So the standard I use, unfortunately, it's got to balance. Okay, 1.5, 25% per tab. Okay. Now, if it balances and you make a mistake, there's partial credit. But if it doesn't balance, then there is no partial credit. Now, I will give one exception because I have to finish posting the grades because they'll be posted soon because I have to basically finish them all and then they get posted. But the point is, when I've been grading the week 3 conversions that you have done, if you got the free cash flow, but you had an unbalanced CFI, I am giving you partial credit. If you got the no plat, but you had an unbalancing TII, I would give you partial credit. Okay, so I am giving partial credit for having at least one of the numbers on an unbalanced statement, meaning there's only one no plat. There's only one operating invested capital. There's only one for the CFI. There's only one free cash flow. So if you get that, but you miss the CFI, you will get some partial credit. But in terms of the actual CFI, both sides had to balance to get credit on that, even if you got one of the 2 right. All right, other questions about grading or logistics or anything else? So this week, you had an assignment to work on target. Okay, and you had this data, and I said, with this data, create the valuations. Okay, now I want to open up my solution here. 5 target, homework 5. Okay, so this is my as is. Obviously, your as is could be slightly different.
I think we just see you right now. I don't see a.
Oh, am I not sharing?
Yeah.
I'm sorry, I forgot to share my screen. Thank you for pointing that out. This is my as is valuation. Sorry, I thought actually the whole time I've been sharing my screen as I've been zipping around stuff. So my apologies that you've just been looking at me. So basically, this is my as is. I'm within 10 cents of the valuation. And I know some of you had emailed me and had some challenges. So here's the trick. I'm going to stop the share, come back to this. And what I'm going to share is a whiteboard. Can everybody see the whiteboard? Okay, so this is unfortunately drawn with my mouse, so it won't be perfect. But this is cash flow on this axis, and this axis is time. Okay, so let's just say you guys have heard of the product life cycle. To some degree, companies go through a company life cycle, which could look like this in the growth stage, then they're mature, then they're declining, and then they could be like, you know, JCPenney and Sears, and they're about to go away. Okay, so to some degree, you have this notion of a product life cycle, but companies to some degree can follow life cycles too. And the argument of McKinsey is nobody stays above average when you get to this mature stage, especially forever. It's hard to maintain competitive advantage. That was one of the things we talked about in EIC. But the other thing is we've been using, as part of the valuation model, the key value drivers equation. And what the key value driver equation is based on is cash flow divided by R minus G. That's the growing perpetuity equation. Now, we rearranged it to get our key value driver equation. No plat times 1 minus G over ROIC divided by WACC minus G is basically this equation rearranged, okay? But here's the key, is that in the original growing perpetuity equation that most people use, they use cash flow. In the key value driver equation, McKinsey breaks out cash flow into no plat and ROIC, okay? So essentially that's just the rearranging that we have done. But the inherent key value driver equation is still this formula. So here, and this is one of the things that they talked about in the book. If you're looking at a company that is at this stage of its life cycle, okay, it's in the growth stage, still growing over time, and you're valuing the business here, okay, one of the limitations of our valuation model is we are arbitrarily going into 5 years. And then we said year 6 is the perpetuity continuing value period. So wherever the company is in year 6, that's the proxy for forever. Okay. Now, if the company's right here and we do an R minus G, and the company's going to expect to grow and eventually mature over time, what you're going to end up with is a G that looks something like this. Because what the G has to do is it has to represent both the period where you're doing better than the sustainable growth rate, and it has to represent the period where you're doing worse than the sustainable growth rate. And it's kind of a weighted average of the two to get your compound annual growth rate over time. Okay. That's why a company that might be growing 8% a year right now is probably still going to have a G of close to 3, because it's never going to grow 8% forever. And eventually it's going to start to shrink. So the 3% proxies both periods. Does that conceptually make sense to everybody? Okay. So is this Target, the company that you just did homework 5 on, is Target kind of an early stage growth that's just going to continue growing as fast as the eye can see?
No.
Okay. The challenge with Target, and this is where your valuation came in, is right now Target's probably right here. And also they have 2 challenges. 1, they're mature. And 2, right now, we're in the middle of a retail apocalypse. So what you have to represent with Target, if I think about 5 years and then perpetuity, is you're representing a vector that probably looks more like that, because it's got to take into account the decline, even if it declines and then goes up, and then eventual decline in the mature declining business. Translation: it's possible to have a negative G. You can't do the Target as is practically unless you had flipped your G to negative, right? Because the problem with the valuation, okay, which we'll come back to in a minute, is that the vast majority of any valuation, if we're only going out 5 years, is going to be that year 6 to perpetuity period. And that's where all the cash exists. That's why G is such an important number in the overall valuation. And the problem right now is for Target, that G is viewed more negatively because people are saying, you know what? Companies like Target are going to be doing less well in the future than they're currently doing, right? And it's not just the Great Recession that we're in. It's also that they're starting to lose ground to the Walmarts and the Amazons of the world. It's very Darwinian. And what they're saying is the better days for Target are probably behind it. And if we were to do an EIC, what people would say is their competitive advantage compared to some of the bigger players, it's not as great as it used to be. And the market is not expecting Target, even when we come out of this period, to do as well. And that's what's reflected in their valuation. So transpose, if you didn't put a negative G, you'd have a really hard time completing the valuation of Target. And what surprised me is a couple of students actually emailed me and they were surprised that you could have a negative G, okay? Because I think their bias was, well, gee, if I have a negative G, that means the company's going out of business. And what I want to represent is no, if your G is negative 1% or negative 2% compounded for a long period of time, doesn't necessarily mean you're going out of business. It just means you have peaked and that the future is worse than the past. Does everybody get that? Make sense? Okay. Here's the other thing that the book also talked about. And again, this could be my poor drawing skills that is relevant, which is if you have a business that is cyclical, and these are supposed to look like waves. And again, my drawing skills are not great with my cursor, trackpad. The problem number 2 lies back to the valuation. If year 6 in our valuation model is right here, and year 6 is your proxy for perpetuity, then guess what ends up happening? This is your year 6. If year 6 in our model accidentally falls here when we go into perpetuity and the company is at the bottom of a business cycle, guess what happens to your valuation? This is one of the other challenges that McKinsey has identified with valuation. And this is why companies, you're like, I looked at this company and its PE is like 60. And as far as the eye can see, they're taking over the world, and the stock price is going up so fast, it's hard to keep up. And then 2 years later, you're like, what the hell happened to that company? It didn't grow as fast as we thought it was. Why is everything coming back to the real world so fast? Because what the market tends to do, and unfortunately the growing perpetuity equation reinforces this, is it exaggerates the current directionality of wherever you are. So when the times are good, times get great forever. When the times are bad, the times never get good and they stay bad forever. So one of the challenges with valuation is that if we represent a particular data point as perpetuity, and you're at the peak or the valley of a cycle, then that just continues forever. That's the other thing that could potentially be happening with Target. Because right now, there's a view that the world's coming to an end economically. We're in this economic crisis. So the other side of it is people are having trouble seeing through to the other side, right? In fact, somebody asked me today, I had the same question came up in our class. Is now a good time to buy airlines? And my point to them was very simple. Do you think we're still going to have airlines in 3 years? Do you think people in 3 years are going to be flying like they did last year? Then the valuation for airlines should be much similar to what they were last year. If that's your belief, the valuation's eventually going to get to that point because they're going to get back to the cash flows they were generating before. So essentially, you don't price them as they're going to go down and never come back, right? Because that would not be reasonable. If you believe that they're going to go back to where they were, then basically what you have to do is you have to basically buy them and hold on. That would be Warren Buffett's approach. Warren Buffett right now, my guess is going to be buying a lot of companies because there's probably no doubt that Delta is going to make it to the other side. Now's a good time to buy Delta. They're on sale because in 3 years, Delta is going to be a strong company. And unless you think that that's not going to be true, then the point is we are exaggerating the directionality of where they are. So back to Target. When we do the as is, and this could be different in your target model for Target. Unfortunately, we've got to say Target twice. What you could have a situation is the as is could say, hey, right now the G's negative and there's not a lot of growth. And you could disagree with that. And you can make the same analogy I just did, which says, you know what, the market's got it wrong. Target's actually going to go back to being one of the top big three dominant retail players when this recession's over and people start spending again. And therefore, my target price for Target should be a lot higher. And therefore, they're a buy. So just like I said, Delta's on sale, Target could be on sale. So there's different ways that you could have spun this. But what I'm telling you is to get to the as is, you're probably going to have to put in a negative G. And negative G doesn't mean that the company's going out of business. That was the first thing I just wanted to highlight before we get to the data. Okay. Saw somebody with a chat question. At least I'm in the chat box. Let's see if I can find the chat box. Stop my share. Go back here. What does the chat say? Buffett is selling Delta. Is that true?
Yeah, he sold like 13 million shares last week, I think.
Okay. All right. Well, maybe he doesn't think Delta's the bargain. But in any event, you could pick Southwest. Southwest is going to make it. Like there's a couple of airlines that I can't imagine are going to go bankrupt, because we need airlines in this country. And for all the politics, we're throwing money at everybody. Somebody's going to let those airlines survive. Okay. There's going to be a couple of them. Now, a couple of them kind of hope crash and burn. Not that people die like the company goes under. Like Spirit, I'm not saying that they should survive. They're evil. They can go away. Okay. But a couple could do. Don't want to see anybody get hurt. So crash and burn is in blow up the company as opposed to people. All right, back to this. I'll just stop talking. Share our valuation. So following the process, you all should have had a tax rate of around 23%. That came from the JP Morgan report I gave you. Everybody get that number for the as is? We use that number? Here's where I got the number from.
I used it 22 just because I went to like the investor relations, their last earnings call, and that's what they had.
Okay, if you sourced it someplace else, I'm
Yeah.
okay with that. But if you actually use the JP Morgan one that I gave you, they said 23.
Okay.
And I don't think there's going to be too much of a difference between 22 and 23. But that goes back to the real world nature. Like, I'm not saying JP Morgan's right. And without access to some of the real sites, like I said, if you got it off of investor relations, all the better. So 22 would be fine. But regardless, you should be 22, 23 range. Okay. Now, the revenue growth rates for the first 3 years, the EBITDA margin, that should have come directly from the earnings estimate screen I gave you. Okay, so if you typed in those numbers, you got those numbers. Okay, obviously you would have put in the share count, share price, and the WACC. All right, so you would have put in the WACC. Okay, now another thing you would have done is you would have put in, come back to G, you would have put in shares outstanding, and then you would have put in the multiples, which would suggested a perpetuity EBIT margin of 6.1%. So the multiples of the time said that this number right here needed to be 6.1%. And the only way that you can make that number 6.1% is if you change that number. And I had to change it to 9.4 to make that 6.1. Okay, so that should have been part of your as is. So by process of elimination, if you had put those numbers in, if you put in the WACC, if you kind of left the balance sheet alone, because the productivity of 0.35 was kind of the midpoint of what they've been historically, and it was last year's productivity. Like, if you left the balance sheet alone, you put in that approximate tax rate, you put in that margin, you put in those first 3 years, then you're just left with growth, and then you're just left with your G.
Professor,
Yes.
why is your no plat 3.9 billions? Because I got 4 billions. I think you might be taking year from 2025. If you look at CV no plat.
M16, sorry, M5, CFI M5. Oh,
TII.
sorry,
TII.
sorry,
Yeah.
TII.
TII.
Hold on. Yeah, M5, 3914. Because basically, my no plat, when I start to shrink, those ratios, when I start to shrink, that no plat's gonna start going down. So that would be one of the reasons why. Now, obviously, your no plat could be different if you use different growth rates. But I guess what I'm saying is, if you got to this point, even if we hadn't had the conversation by G, what you'd be left with is something's got to go negative here, because you can't have a positive revenue growth rate and a positive G and get to the share price, right? Because even if you had put your G at 0, you'd be at negative, or you'd be at $10 off the share price, and this would have to be like negative 10% a year or negative 8% a year, which is possible, or negative whatever, negative 4, whatever is negative 5. Now, you could have made an argument that it was not going to grow long term, and they're just going to have this kind of like U-shaped recovery. So that would have been another way that you could have done that. But either way, one of those two would have to be negative. All right, either G was negative, or the next few years had to be very negative with growth, which I'm not saying it can't be negative, but here's why I was leaning towards the G, which is these 3 years would be the time of the recession. So coming out of the virus stuff that we're dealing with now, that's not 2024. So we're talking about really dramatic pain here in the last 3 years at negative 5%, which seemed a little dramatic. So if this was negative 5%, I would understand. But this being negative 5% led me to believe that it was more of a G long-term to be negative than these 3 being negative. But if you had made these 3 negative and the G close to positive, for purposes of this assignment, I'm not going to mark you down too much. but as you think about your final projects, I would like you to kind of think through the assumptions that you're actually putting out there. So I'm going to pause. Is this kind of what you guys got? I didn't really review what you turned in today yet. So you tell me. Back to switching the G. Like, how'd you guys get the as is?
Yeah, I had them both negative, like a negative 1.25 G, and then I stepped the growth rate down, the revenue growth rate down from like -0.5 to -3/4 to -1.
But basically similar to what I did.
Yeah, same thing.
Yeah. Okay. Now you could have had slightly positive here, more of a negative G. That could have also gotten you there.
Yeah, that's what I had. I had about 0.4 positive
Yeah,
revenue
that's what I
growth,
did as
and
well.
and then for G, I had like negative 1.4.
Which again would be fine, because if you go back to my whiteboard, what we're really saying is, and this is the other reason I want to bring it up, is if you look at the valuation tab, just think about it this way, right? Their value, 61 billion is operating value. They have very little non-operating value. And if they're worth 61 billion at the share price, 47.5 billion of that is the continuing value. So changing a year, which might knock NOCLAD down by a couple hundred million, not going to affect the share price all that much. Okay. It's that continuing value that has the biggest impact on the valuation. It's year 6 to perpetuity. And that's just what makes it the most sensitive to any valuation that you do. This, unfortunately, is the 80-20 evaluation. It's the continuing value. And the sad part about it is that this, which is 80% of a company's value, basically boils down to 4 numbers. So those are the most important 4 numbers to your valuation. Okay. Now, the good news is most people can say reasonably they're probably not going to be too far from the Bloomberg number for WAC. So most people would say this seems probably reasonable. So it's really these 3 that are going to have the biggest impact, right? But here's the key. If you actually start changing the numbers, what you quickly see is the most important number is the G. And that has the very large fulcrum at moving the stock price up and down. So it really boils down to coming up with a reasonable G. Okay. So how do we come up with a reasonable G? That's the, they used to call it what, the $64,000 question a long time ago. So let me give you one other thought. So in our model, we're going to add one more thing. Now this gets into the week 6 content. We haven't gotten to the week 6 content, but you will be doing this if you haven't started the reading yet next week, right? And what I want to bring up as part of the week 6 content is pull out a lecture note for week 6. All right, when do we get to the week 6 content? Can you still see this? Am I still sharing? Great. We talk about multiples. One of the things that you're going to learn, which is part of one of your earlier homeworks, and again, this is next week, but multiples are just the rearranged key value driver equation. Okay? So a price to earnings multiple is just the rearranged key value driver equation. An enterprise value to EBIT multiple is a rearranged key value driver equation. An enterprise value to sales multiple is the rearranged key value driver equation. Okay, so one of the things, and this is one of the derivations in the book, and something I'll talk about in the videos for this coming week, is if we take our key value driver equation we've been using since the beginning of the semester and we rearrange it, we get the enterprise value to EBIT multiple. Okay, this is how you create an enterprise value to EBIT multiple. So if you were to hire JP Morgan to basically say, I work for a company and we're going to take one of our divisions and we're going to sell it off, they do 2 things. First, they go look at comps in the real world and say, these types of sales sold at these types of multiples. Second thing they would do is they'd run the cash flows because they know that this is what creates that enterprise value to EBIT multiple. And they try and build out the cash flows for the company to say, based on the cash flows, here's also what the multiple should trade at. And then they would triangulate. So the point is, and this is next week, this is the formula for enterprise value to EBIT. So I started this conversation by saying G is very critical. So here's the point. In the real world, we know a company's enterprise value to EBIT. In the real world, we know the formula that should lead to that enterprise value to EBIT. What are the parts? One, tax rate. I think we can reasonably agree that the tax rate is pretty easy to forecast for Target. So there's not going to be a lot of difference in the tax rate that we think Target's going to have. The WACC for Target, again, is going to be pretty standard. So hopefully we're not going to change what the WACC assumption is across all our models. The ROIC tends to be stable for these mature companies, given the margins and the productivity. So we have a reasonable expectation of what the ROIC is for Target going forward. So here's the point. We can solve for G. We can actually use the real world enterprise value to EBIT multiple to solve for G. Okay? And that is what I'm about to do. So to get a sense of the G, what we're going to do is we're going to say take the forward year 2. We're using second forward year. One of the things we'll talk about because we care more about the forward multiples, not the historical multiples. Enterprise value to EBIT multiple, which by the way, that was the same one we used there, 11.4, when we did the estimated margin. And then we can have a model EV to EBIT multiple, which we will solve for using this equation. And this equation has 4 things associated with it. It will have a continuing value tax rate. It will have a continuing value, you see the other parts of this? A continuing value, actually I'll make the first one, the G, which we're going to be solving for. Tax rate, a continuing value ROIC, and a continuing value WACC. Those are the 4 parts of the equation. So here's the point. This is the G that we're using in our model. This, if I go to my ratios, is the tax rate, assuming we're not changing it, H10 in our model, 23%. This is the continuing value ROIC, and this is the WACC. Those are the 4 parts that will create enterprise value to the multiple. So here's the point. If I put this formula into this model equals left paren 1 minus the tax rate times left paren 1 minus the growth, which is this cell, B21, divided by the ROIC, which is B23, right paren. And if I take all of that and divide by WACC minus G, that would be the multiple using this data that Target should trade at. And that's Target's actual multiple. So to be honest with you, negative 1%, probably not negative enough. Negative 3, negative 2, 2 decimal places, negative 1.95, maybe 1 point, something like that. Oh, 21, sorry, right around, type. Yes. 2.1%. Ah. Sorry, just killed my formula there. Negative, was it 1.85%. There you go, negative 2.1. So based on Target's trading multiple last week, when they were trading 11.4 times EBIT, which was from, we go back to Target, that number right there. The enterprise value to EBIT in the second forward year, that 11.4. That suggests Target has into perpetuity a negative 2% G. So if I make this negative 2.1, which is actually what I should do here, refer to that cell, I should change it up there, come back and forth. Then if I go back to my share price, it's probably that. That's the as is. So whoever said that they think they have a positive growth rate for a few years and then negative, that would be the correct answer. File, save as, Target, homework 5, solution. Questions? Went through a lot very quickly. This makes sense to everybody? Okay. So final part, and I will upload this file, okay, as a solution to homework 5 now that the deadline's passed. So here's the point. When you work on your team projects, use this. To help you figure out the G. Okay, so what you did for homework 5, which is acceptable because we didn't cover this in class, is you eyeballed it. And you made a guess between one or the other. All right, and you got close. But what I'm saying is we can actually use the trading multiple data to get even closer because we know what the academic formulas are and therefore we know what the G has to be. All right, so since we have a pretty good idea what the G has to be based on the trading multiple and the other 3 variables, then I can back into what's probably realistic here. And to be honest with you, this is probably more realistic because assuming I'm still logged into Bloomberg, actually, I don't know if I am. If I were still logged into Bloomberg, I'd be willing to bet that the analysts don't have negative growth rates in 24 and 25. Even the ones that are publicly out there, they're not saying negative. They have some positive growth there, right? Because what they're doing is they're putting a negative G on the company. All right, now that doesn't mean that that's the final verdict. It just means that to replicate a 92.57 share price, that's how you do it. That's how we understand the math to get to that share price. That's the whole point of the as is. All right, so with that in mind, help me understand your bowl. Somebody tell me how you did the bowl from here. What did you change? And how did you create your bowl? Approximately. Well, what's different?
So I guess on mine, what I did, obviously, I left the tax rate unchanged, the balance sheet unchanged, and then I had the revenue growth rate at 3% because I had negative growth rates in there before, so it was 3% for those 3 years.
Okay.
And then on the for the assumptions, I mean, I can give reasons why I did that. I mean, I felt that they, a lot of like the current pricing was due to slowdowns in business because of COVID-19. But
Yeah, do you have the file on your desk?
yeah, I'm looking at it right now.
Say what? I'm going to stop my share. Why don't you go ahead and share your desktop and just pop it up? That way everybody can see what you're walking through.
Yeah, let me see if I can even do that.
So along the bottom of Zoom, there's a share button. And the easiest way is you can either share
Oh, yeah, I see it.
or you can share your Excel, which, by the way, this is good practice for when you guys do your final presentations.
Do you see my screen or?
I do.
All right. So both of them here, I guess.
Yeah, just focusing on the Excel file, not the write-up.
Yeah.
Just
So, I had changed this right to get the operating income remained unchanged, so just kept that the same. Didn't change the balance sheet based on what we already discussed, so this remained unchanged. And then I changed the revenue growth rates to 3% based on some of the things that I read and their ability to kind of generate revenue, I think, from in the future online sales and yeah.
so summarize a couple of the things that were very positive for them. It was positive for them, your bowl.
Yeah, so I think like a historical growth rate was around 3% for them from what I saw on their investor relations site. I didn't think it was going to be much higher, called out because they're mature company in a mature industry, but they're also kind of innovating for target standards as far as competing with Walmart and Amazon with their digital sales and same day sales. So their year-over-year growth was 25% in digital sales and same day sales was 90% in recent years, or I think that was in 2019 based on some articles that I found and some reports. So I felt that if they could continue that trend, they could at least compete and have, relatively similar growth to what they had before, but based on the maturity of the industry, they weren't going to like knock it out of the park. And based on the strength of their competitors. So I felt that 3% in the 3 to 3.5% range was pretty.
All right. So you have about 30% upside at 120, given that story. And that's what I want you to do. I want to relate that story to the upside and then the changes that you made. So since you got it here, do you have your bear model?
Yeah, I can pull it up.
So what was your story of Target's downside?
So this one I kind of like, I don't know, went off the reservation a little bit, but I felt that the again, like smaller growth, just because mainly kind of like the opposite of the things that we talked about, because there's a lot of narrative surrounding that where, Amazon and Walmart are so big and they have such scale that it's really hard for Target to compete with them sustained. And then I also messed around with the tax rate a little bit, kind of played into some of the like political factors going on, felt that it was possible, based on all the stimulus and stuff going on, that there would be a greater dependence just from the consumers in general for the government to help out. And there would be a much higher tolerance for increases in the corporate tax rate, and kind of talked about the possibility of, changes in the, with the election in the fall, kind of going back, swinging the pendulum, swinging a little further back towards like the 35%, the Obama era. So I talked that up a little bit and found some stuff that kind of just somewhat. Drove, that drove it down to, around $80. And I think I maintained a negative growth rate just based on them being in, in a pretty mature industry and their inability to really innovate at the scale and compete with Amazon and Walmart.
Okay. So if I can translate, upside 30%, downside 15 between
Yeah.
the models.
Yeah.
So you actually see more upside in Target than downside at the current price
Yes.
in the bull versus the bear. Where did you end up with your target for Target?
I think I was at 90. I was at 101, I think. I'll pull it up.
So you had a little bit of a buy,
Yeah.
which given your bias based on your range is not completely surprising. Since you
Yeah.
said there's more upside than downside and you put them closer to the high side of the range.
Yeah. And I actually I'm going to even maintain the same kind of assumptions regarding the tax rate and things going on with a little higher growth rate. And then in this, a very small,
But
half
here's,
percent G.
but here's the other reinforcing thing for everybody to recognize with Target. A couple of percentage points of growth and 1% in margin is everything. That's like $40 worth of share price right there. So very sensitive to changes in growth, very sensitive to changes in margin, just because of the size of the company and where they are. So that's the other thing when you start thinking about how these models are changing the price, how little change in growth actually is necessary to really move that price up or down. Okay. Now, where did other people come in? Were others on this class call similar to his range? Thank you for sharing. In terms of the bear, anybody a lower bear or a higher bull or approximately that range? No one else has an opinion?
I had a little bit wider of a range. So I think the reason for that is I played around with the EBITDA a little bit more. So in the bull scenario, I assumed that they would actually grow their EBITDA, assuming that some of these smaller competitors would fall out of the market and they would be able to charge higher prices as there's less competition in the space.
So how high did you get your EBITDA margin?
It was up to 10.5, so it was only 1 percentage point higher.
Okay, and that led to what kind of a share price?
Around 150.
Yeah, as I said, slight changes in margin, huge impacts on share price.
Mm-hmm.
So,
and then in the bear scenario, it was kind of the alternative. I decreased the EBITDA, and that led to like in the $50 range for the bear.
So there's two things that you're saying, whether you're right or you're wrong, is that you think that in the bull or the bear, the margins could have more volatility in your model versus the first model that we were looking at. Right?
Correct.
So essentially in your story, in your write-up, it would have been ideal if you kind of explain why there would be so much margin volatility between the bull and the bear.
So in the bear, I explained it by saying more traffic was going to be drawn to Amazon because of COVID, and they're going to be really, forcing lower prices against them. And in the bull scenario, I gave less weight to Amazon stealing market share. I kind of said that Target would be able to pick up some of that traffic as Amazon's gotten overrun with, they can't even meet their 2-day deliveries. I think they're till the end of April for deliveries. So people will look for alternatives. So in that scenario, Amazon wasn't as much of a factor, but the smaller businesses dropping out is what allowed them to increase their EBITDA.
So again, there's two couple scenarios, and it's important to kind of highlight both. Where do you think Target's going to end up? What was your final target for Target?
My final target was, I think, around $80.
So you're more pessimistic about Target. You put them in the sell category.
Yeah, I think they'll pick up some of their online traffic with the free shipping if you spend over $35, as people are looking for alternatives to Amazon. But I don't think that's enough to offset the declines in basically every other aspect of their brick and mortar stores. The only thing that'll see growth is the grocery and daily essentials, but the sporting goods, the apparel, all those departments in Target are going to struggle and won't see any growth.
And by the way, even though the two of you had slightly different opinions, I can't say that either one of you are wrong. All right. And that's the point. I think you had kind of reason logic for either one. And that's part of the process, is to kind of work it through. Now, in the real world, obviously, one of you will find out if we're right or wrong. And then one of you will have a job, the other gets fired. But that's okay. But regardless, that's kind of the way that the world works. But right now, there's people in both sides of it. And then that's what I want you to kind of understand for the companies you're covering, and then make a call. You got to make a call. I appreciate both of you willing to do that. All right. Does anybody have any other thoughts they want to share about the target, the valuation, their buy, their sell, their hold? Any questions about what we did here tonight? Do you feel you could replicate this in another company? Or more specifically, your team company with what we did?
Just to clarify, like when we're doing the as is valuation, like the way to think of that is what the cash flows would have to be to pretty much support the current share price, right? And then we develop, so that's almost like we're just confirming what is already done. Like there's no opinion to be had there. It's just like, this is what the model says they should be to support this. And then we use that as the kind of the foundation for the rest of the analysis. So to make sure it's framed correctly when I'm looking at it.
You're exactly right. And there's two parts of the framing I want to continue to reinforce. Part number one is we're assuming that the academic formulas work in the real world.
Yeah.
Okay. So assuming the academic formulas work in the real world. And number two, take your opinion out of the as is. Because I ran this class 2 years ago, and I felt bad for this student because it was getting combative, because we were valuing an airline and he couldn't get over his own bias that airlines suck. He was just so entrenched in his mind because he took some undergraduate class a number of years ago and he did a case study on the airlines and Warren Buffett's jaundiced view of the airlines, and just like airlines are an awful, horrible business that you'll never make money in. And that's actually not the airline industry today. The airline industry today is a, basically a non-competitive oligopoly that basically charges a lot of fees, has restricted supply, and 80% of capacity is for airlines that have these fortress hubs. And the business has changed in an era of lower oil prices. Oil is like 26% of an airline's cost. So today the airlines are actually, well, today as of the time, they were doing pretty well. And he couldn't get over it. He was like, he couldn't believe the data he was seeing on the screen. And what I was trying to say is, it doesn't matter what you think. They're priced that way. You got to figure out why they're priced that way, not whether you agree that they're priced that way. You could still come in and say they're all going to be wrong and the airlines are going to go to hell in a handbasket, but that's not the as is. That's the target, right? That's your bull and your bear. That's when you start to insert your opinion. Your opinion is your opinion, okay? As is not the opinion. And by the way, in the real world, people don't do an as is. They go straight to the target. This is something that I'm pushing, right? Because I think it's instructive to know what types of baseline assumptions have to be made before I start making my own crazy assumptions, right? Because it'd be really easy to start making assumptions about G and ROIC that are my own that have no sense of reality because I don't know what reality is. So by doing the as is, it gives me a baseline to start. And I said, I don't have to agree with it. So everything you said is true, but it's actually very useful. And by the way, once I actually have my students that go to the real world, they keep doing as is because I actually find it helpful because it helps them get a baseline. At least what are all the analysts thinking? What is the market thinking? What is the buy side thinking? Can I find any mispricing out here? Right? Because every now and then you're going to get some stuff that just makes no sense to you when you try and do this as is. So yes, everything he said was true, just reinforcing. Any other thoughts, comments about this week's assignment? All right, so we're probably going to end a little bit early. So I just want to reframe next week. There's 3 major things for next week. Major thing number 1 for next week, I'm just again resharing my desktop, is number 1, I'm going to put into the team projects the rest of the data to do the valuations. Okay, so that look for that sometime by tomorrow morning, with the exception of Costco, where it's already there today. Right now, number 2, there's a midterm exam which will be available from tomorrow morning that has to be completed by next Tuesday, end of day, okay, midnight Tuesday. Okay, it's just one midterm exam. Okay, you'll take it. You can take it from here home. Week 6 or week 5. It's actually in week 5. There's a midterm exam link, and it'll bring you right to the midterm exam. Okay, or you can go to assignments and midterm. And as I said, I combined the midterm 1 and 2 to 1. I got rid of the essay questions. Just a conversion gives you the 1, 2, 3, 4s. Open book, non-collaborative. Submit back to the file that I gave you. Okay, so download the file, convert the file, submit the same file. And then finally, the other third thing is we're going to be doing stuff on multiples. Okay, and so basically when you do the multiple stuff, look for under announcements the data to do the multiple analysis, right, where it's been. So that's going to be for homework 6. Right. Finally, and I'll mention this, my undergrads, TAs, ironically, I have 4 of them, which are a lot less busy since we've gone online. My undergraduate TAs are having Zoom office hours on Thursday and Friday morning. Okay. So if anybody needs some TA assistance and you just want to talk to them to go over anything, the undergraduate TAs know this content because they've gone through actually a 14-week version of what you're doing in 7 weeks. Okay. And these people all got A's in my class and they're smart. So if you want to use them, feel free to take advantage of their office hours. What they're doing is they're Zooming office hours. So you can just go into their Zoom room. It's open for these 2-hour blocks, and you're welcome to ask questions about something. And I told them that I was going to make this as an option to the online MBAs if anybody had questions about anything. So you're welcome to take advantage of their office hours. Now it's during the day, but regardless, if you're sheltering in place and need some time to do some stuff, but I'll make this available to you. Okay, so starting tomorrow, they will have office hours, and then one has office hours on Friday. So just another opportunity if you need help on anything. Okay. All right, so I'm going to go ahead and stop the share. I'm going to go ahead and stop the recording, and we will see everybody next Wednesday night. All right, have a good day. Stay safe.